Good evening, everyone, and welcome. You heard of the polar vortex? How about the stock market vortex? It sure felt this month like the only thing falling as fast as the temperatures was stock prices. Add it all up or down, as the case may be, and you get the first January decline for stocks since 2010 and the worst start to a new year since President Obama's first month in office. For the month, the Dow lost 5.3%, NASDAQ down 1.7%, the S&P 500 split the difference, losing 3.6%. Pick your poison. Earnings and outlooks have been iffy. The Fed is cutting stimulus even more, and emerging markets aren't so much emerging as submerging. Just a pullback or something more? We'll discuss that in detail tonight. Meanwhile, today, the market dipped early, recovered, then swooned again, and here's how it finished. The Dow fell 149 points, bouncing off an early 220-point loss. The NASDAQ was down 19, and the S&P lost 11. With money coming out of stocks and going into safe haven bonds, the yield on the 10-year Treasury fell from Thursday's level.
Well, you could also blame the bad January on the emerging market crisis and the sell-offs in those countries. Sarah Eisen has more on what's causing the turmoil and what needs to be done to stop it.
What's emerged from the emerging markets in recent weeks has been troublesome to investors. Almost $6.5 billion were drained out of emerging market stock funds this week, the most in more than 2 years, and $3 billion more from bonds. Why? Interest rates in India, South Africa, and Turkey jumped this week. With money becoming tighter, GDP growth becomes more difficult. The leader of India's central bank complained about a lack of global policy coordination. And the International Monetary Fund issued a call to arms, asking central banks for vigilance over liquidity. There could be more moves next week as the leaders of both the European Central Bank and the Bank of England huddle on the heels of lower inflation data in Europe, and central banks in less developed countries, Australia, Poland, the Czech Republic, and Romania, will also be meeting. To some, like Bank of America's David Wu, this was bound to happen once the U.S. Federal Reserve decided to pare back or taper its economic stimulus. With fewer dollars available, the ones that are out there will cost more.
Volatility across all markets was near historical low. People thought tapering was going to be a non-event. I think that was where the market was extremely complacent. Because if QE has played such a big role, I think the market is simply underestimating what it means when liquidity is finally being withdrawn.
Stabilization could come from better economic data, which has been iffy recently at best. Still, pros say the outlook is bright for emerging markets in the long term, but in the short term, there are significant headwinds, many of which can be traced to China.
We all know emerging markets is 75% China. Because emerging markets are either indirectly, exporting to China or directly exporting to China.
Slower growth in China has reduced the need for imports, raw materials, energy sources. And for now, at least, investors would be wise to buckle their seatbelts. For Nightly Business Report, I'm Sarah Eisen.